Hey everyone, welcome back to the channel. Here, we're learning about money, step by step, in simple, everyday language. No complex finance terms, no pressure. Just real lessons to help you build financial confidence from scratch. Now, let me ask you something. You work hard for your money, right? But what if your money could start working for you, even while you sleep? That's the power of investing. In today's video, we're breaking down investing for beginners. No confusing jargon, no fancy Wall Street terms. Just real talk about how to make your money work for you, even if you're just getting started. Because here's the truth, saving money is important, but saving alone won't make you rich. Investing is what turns your savings into real growth over time. By the end of this video, you'll understand why saving alone isn't enough, what stocks, bonds, and funds actually are, the power of compound interest, your best financial friend, common investing myths, and what's actually true, the biggest mistakes beginners make, and how to avoid them, how to start investing step by step, how much you should invest, even if you're on a small budget, how to spot and avoid scams that target beginners, how to build a strong, confident investor mindset, other types of investments, from real estate to crypto and beyond. So grab a coffee, hit that like button, and let's make your money start working for you. Part 1. Why saving alone isn't enough. Let's start with this question. If you save $10,000 in a bank account, what happens after 1 year? Most banks today offer an interest rate of around 0.1% to 1%. That means after a year, you might earn $10 or $100. Not bad, right? Well, except for one problem: inflation. Inflation means prices rise over time. If inflation is 4% per year and your money grows only 1%, you're actually losing 3% of your purchasing power. Inflation rates vary. Check local CPI. So saving is safe, but it won't make you rich. Think of saving like keeping seeds in a jar. They're protected, yes, but they'll never grow. Investing is planting those seeds, letting them grow into trees that produce fruit year after year. That's why we say, saving protects your money. Investing multiplies it. Part 2. What investing really means. Investing simply means using your money to buy something that can grow in value or generate income over time. There are many ways to invest, but the most common and beginner-friendly are stocks, bonds, and funds. Let's break these down simply. Stocks. When you buy a stock, you're buying a small piece of a company. If that company grows, the value of your share grows too. And sometimes you even get paid dividends, a small share of the company's profits. Bonds. Think of bonds as loans. You lend your money to a government or a company, and they pay you back later, with interest. Bonds are generally safer, but the returns are lower compared to stocks. Funds. Funds are baskets that hold many different investments. Instead of buying one company's stock, you buy a mix of many, which lowers your risk. Two popular types are mutual funds and index funds. Index funds are especially great for beginners. They track the overall market, S&P 500, MSCI World, local indices. Choose a broad, low-cost fund that matches your goals. That means you don't have to guess which stock will win. You invest in the entire economy. Part 3. The power of compound interest. Now, let's talk about the magic behind investing. Compound interest. Albert Einstein once called it the eighth wonder of the world. Here's why. Let's say you invest $1,000 at a 10% annual return. After 1 year, you earn $100 in profit. That's your interest. Next year, you don't just earn on your original $1,000, you earn on $1,100. Your interest earns interest. That's compounding. And over time, it's unstoppable. If you invest $200 per month starting at age 25, by the time you're 55, assuming an average 8% return, you'd have $298,000. But if you wait until 35 to start, you'll end up with $180,000 less, even though you invested only $24,000 less. The earlier you start, the more time your money has to grow. Time is your most powerful investment tool. Part 4. Common investing myths. A lot of beginners are scared of investing. They think, I need a lot of money to start. Or, it's too risky, I might lose everything. Let's bust those myths. Myth number 1. You need thousands of dollars to invest. Nope. Today, you can start with as little as $10 using investing apps or online brokers. Myth number 2. Investing is gambling. Wrong again. Gambling is based on luck. Investing is based on time, discipline, and diversification. Myth number 3. I'll just wait until I have more money. Big mistake. Waiting costs you time, and time is compound interest's best friend. So start small, start early, and stay consistent. Part 5. Mistakes beginner investors must avoid. Let's talk about the traps that cost beginners thousands. Mistake number 1. Trying to time the market. Even professional investors can't predict market ups and downs perfectly. It's better to stay in the market consistently than to try to time it. Mistake number 2. Putting all your money into one stock. That's risky. Diversify. Spread your investments across different companies and industries. Mistake number 3. Panic selling. When the market drops, beginners panic and sell. Historically, broad markets have recovered over long horizons, but recovery timing varies. Invest with a long-term horizon. You can weather short-term drops. The biggest investors make money because they stay calm when everyone else panics. Mistake number 4. Ignoring fees. Some mutual funds charge high fees that eat into your returns. Look for low-cost index funds instead. And most importantly, invest only money you don't need right away. The stock market rewards patience, not panic. Part 6. How to start investing. So how do you actually start? Here's a simple 5-step plan for beginners. 1. Build your emergency fund first. You need savings for unexpected expenses, usually 3 to 6 months of living costs. 2. Pay off high-interest debt. No investment beats paying off credit cards charging 20% interest. 3. Open an investment account. This can be through your bank, a brokerage app, or even a retirement account like a 401k or IRA. 4. Choose low-cost, diversified funds. Index funds or ETFs are ideal. They give you instant diversification. 5. Automate your investments. Set a fixed amount each month and forget about it. That's how you build wealth on autopilot. Part 7. How much should you invest? This is one of the most common questions, and the answer depends on your income, expenses, and goals. But here's a simple rule that works for most people. Start with 10 to 15% of your income. If you can only start with 5%, that's fine. The key is to start and be consistent. Here's how it fits into your budget. Use the 50-30-20 rule as your base. 50% for needs, 30% for wants, 20% for savings and investments. As your income grows, try not to increase your lifestyle spending proportionally. Instead, increase your investment percentage. That's how wealth builds quietly in the background. If you already have high-interest debt, focus on paying that down first before you invest heavily. Because if your credit card charges 20% interest and your investment earns 7%, you're still losing money overall. Golden rule: never invest money you can't afford to leave untouched for several years. Investing is for the long term, not for quick profits. Part 8. How to avoid scams and fake investment opportunities. Unfortunately, where there's money, there are scammers. New investors are often targeted with fake, too-good-to-be-true opportunities. Here's how to protect yourself. If someone promises guaranteed returns, it's a scam. Real investments always carry risk. Never invest in something you don't understand. If you can't explain it simply, don't put money in it. Avoid unlicensed platforms or individuals. Only use regulated brokers and funds. Be cautious with crypto projects and MLM schemes. Many are just modern versions of Ponzi schemes. Check reviews and official registrations before transferring money anywhere. And remember, if it sounds too good to be true, it almost always is. Part 9. Building an investor mindset. Investing isn't just about numbers, it's about mindset. Patience, discipline, and emotional control matter more than market knowledge. Don't compare your results to others on social media. Most people only show their wins, not their losses. Real investors play the long game. They don't panic when prices drop or brag when they rise. Set clear goals. What are you investing for? financial freedom, retirement, a home, your children's education. How long can you keep your money invested? When you know your why, you'll stay calm through market ups and downs. Part 10. Other types of investments. Now that you understand the basics, stocks, bonds, and funds, let's explore a few other types of investments you'll hear about as you continue your financial journey. These aren't always beginner-friendly, but it's good to know what's out there. 1. Real estate. Owning property is one of the oldest and most proven forms of investing. You can make money in two ways. Appreciation, when your property value increases over time. Cash flow, when you rent it out and earn monthly income. But real estate isn't easy money. You'll need capital, patience, and the ability to deal with maintenance costs, taxes, and sometimes tenants who don't pay on time. Still, it can be a great way to diversify once your finances are stable. 2. Index funds and ETFs. We already mentioned mutual funds, but ETFs, exchange-traded funds, deserve a special note. They're like baskets of many companies' stocks, giving you instant diversification. But they trade like regular stocks. Think of it as buying a tiny slice of hundreds of companies at once. Cheaper and safer than picking one. 3. Retirement accounts. Depending on where you live, you may have access to tax-advantaged accounts like a 401k or IRA in the US. They allow your money to grow tax-free or tax-deferred, which means more of your earnings stay invested. The earlier you start, the more powerful the compounding becomes. Even small contributions now can turn into thousands later. 4. Commodities. These include things like gold, oil, or agricultural goods. Some people buy them as a hedge, to protect their money when the stock market falls or inflation rises. But they're very volatile and not always ideal for beginners. 5. Crypto and digital assets. Yes, we have to mention it. Cryptocurrency. It's a new, high-risk market. Prices can jump or crash overnight. If you ever invest in crypto, keep it as a very small percentage of your portfolio, and only money you can afford to lose. Never fall for hype or guaranteed returns. That's where scams love to hide. Let's recap. Saving protects your money. Investing multiplies it. Compound interest is your best friend. Diversification reduces risk. Patience builds real wealth. Start small, start early. Invest 10 to 20% wisely. Avoid too good offers. Think long-term. Stay calm. Explore other ways to invest. Here's the beauty of investing. Once you've set it up, it works quietly in the background. Your money earns money, and that money earns even more money. Every night you sleep, every weekend you rest, your investments keep growing. This is how ordinary people, not just the rich, build financial independence. They let time and compounding do the heavy lifting. If you're serious about making your money work for you, start small, start today, and stay consistent. Question for you. What's holding you back from investing right now? Let me know in the comments. I read everyone. And if you found this video helpful, hit like, subscribe, and check out the previous episodes. Budgeting basics, saving money, smart spending. Let's keep building your financial freedom, step by step. See you in the next video.